You've probably heard people say, invest your money so it can grow, or invest for retirement. But what does that even mean? Like, what are investments? And how do they make you money? Money doesn't magically just multiply. So, where does that extra money come from? Well, let's get into it. Most investments you'll encounter will fit into one of four broad categories. You can lend money, you can own a business, you can own property, or you can buy rare items and hope that they increase in value. In finance speak, we call those debt, equity, real estate, and non-productive assets. Let's start with debt. Debt is when you loan your money to someone else for a certain period of time, and in return, they pay you back with interest. You can loan it to a government, a corporation, or a bank. Each of those are a little bit different, but they're all loans. And with each of them, there's a fixed period of time, a fixed interest rate, a fixed payment schedule, and then you get your money back at the end plus the interest. That's why this category is often called fixed income. It's because of the fixed income payments. But if you hear someone talk about a portfolio of stocks and bonds, well, this is the bonds part. And how does it make you money? Well, it's the interest payments. Someone is paying you for the privilege of using your money for a while. The next category is equity. Equity is fancy finance word for ownership. When you buy a stock, you're buying a tiny piece of a business. The shares that you buy represent fractional ownership of that company. That seems kind of abstract, so I like to explain it this way. Imagine that you want to buy the dry cleaners down the street from you, but you don't have enough money to buy the whole business by yourself. So you get 9 of your friends together, and the 10 of you each put in 10% of the purchase price. So you all buy it together. And then you each own 10% of the business. So when that dry cleaner makes a profit, you're entitled to 10% of those profits. You also own 10% of everything that the business owns. So like 10% of the building and 10% of their dry cleaning equipment, whatever that might be. That's what happens when you own a stock. Big corporations don't just have 10 owners. They might have millions of owners, but the principle is the same. You are part owner of the business. And so you are entitled to a fraction of their profits and a fraction of any assets that that business owns. Now, why would you do that? Well, businesses exist to make money. Everything that they do is an effort to develop new products or grow into new markets and serve customers well and find ways to be efficient so that they can keep more of that money that they make. And so if the business does that well, then they will grow and increase in value. And part of that growth and profit will also flow through to you. So you make money by those shares increasing in value. Or some companies will also share their profits in the form of dividends, which are cash payments to their shareholders. And by the way, when I talk about buying businesses, I almost never mean buying just one company. My favorite approach is buying thousands of companies all at once through an index fund, but we'll cover those in future videos. The next type of investing is real estate. Real estate usually means buying a property that you rent out. So that can mean like single family homes or apartment complexes that you rent out to people, or things like strip malls that you might rent out to businesses. How does this make you money? Well, you get those rent payments, and you own a building that will hopefully increase in value over time. And with real estate, sometimes you can get your hands dirty and fix up distressed properties, and you can increase their value that way too. Finally, we have the non-productive assets. That's a pretty broad category, but think about things like gold, cryptocurrency, art, baseball cards, limited edition Beanie Babies, things like that. What do you notice about all of those things? Well, there's a reason that we call them non-productive assets. That is nerd speak for things that just sit there. They don't generate regular interest payments or rent payments. They aren't businesses that are trying to grow and create profits for you. They don't multiply or reproduce. They just sit there. People value them because they're rare, because they hope that in the future somebody will be willing to pay more for them than what they originally paid for them. That doesn't necessarily make them bad investments. I mean, there are a lot of people who own gold or cryptocurrencies as part of their portfolios, But I just think we should be very clear on the fact that they do just sit there. They don't do anything else. And you're just hoping that they will increase in value. So here's the question that I want you to ask anytime you're looking at an investment. How does it make money? If the answer is interest, then it's probably debt. Business profits, then you're buying ownership. If it's rent, then it's real estate. And if the answer is hopefully somebody else pays me more in the future, then you're looking at a non-productive asset. That one question will help you understand almost every investment that you ever encounter. So why did I spend 10 minutes explaining all of that? It's because once you understand how an investment makes money, you stop treating investing like it's magic. You stop feeling like you're gambling or guessing. You can actually look at an investment and understand what's going on underneath the hood. Every investment is making you a promise. It's saying, I'll pay you interest. I'll share the profits of a business with you. I'll give you rent payments. I'll just sit there. Maybe I'll go to the moon someday, I don't know. Maybe I'll go to zero. Every investment is making you a promise. And once you know what promise you're actually buying, you're less likely to be fooled by hype. And you're less likely to panic when there are changes in the market or when prices swing. It's really valuable to really understand what you actually own. As we learn about investing, every step of the process should sit on a firm foundation of understanding why. Why do we invest at all? Well, we want to build financial security and we have financial goals we want to achieve. And eventually we want to reach a point where our investments start doing some of the work for us instead of every dollar coming out of our paychecks. Because that buys our freedom. Okay, great. So now why do different investments make money? Why do we choose one over another? If you understand the why while you're taking each step, you can be confident that you're on the right path and you're making the right decisions. So let's keep going down this path together, shall we? Now that we know how investments make money, we can start talking about their pros and cons. They'll each have a unique risk and reward trade-off. And so you'll start to see why they might be used by different people for different kinds of goals. And by the end of this video series, you'll understand the trade-offs well enough to confidently choose investments that fit your goals. But in the meantime, if you have any money questions, please send me an email. The email address is listed in the video description. I'm always happy to hear from you. And please consider subscribing if these videos have been helpful to you. I hope you have a great day. To the moon! To the moon!